Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boissono with Kevin Casey, and we will soon be joined by Dr. Selma Hepp, who is wrapping something up, and then she will be here. So, good morning, everyone. How are you? So weird without a third person on the screen. You know that?
Yeah. Yeah, I told you already, I'm not doing so great. I didn't do my Wordle this today. What the heck? No.
Okay, so Kevin apparently has now decided that his days are all dependent on how he does in his games in the morning. I just don't even get it. It's
Apparently,
so
I'm
weird.
not. There was a big article about New York Times, I think it was in Freakonomics about their games. That's a big thing for them. Like half the
Oh,
world
it
there.
is. Actually, I heard the woman who created or does the not Wordle, but anyway, the
Hmm.
connections. Heard her being interviewed. She was super cool. I liked her. Okay, enough about
I
that.
think
We're going to
I
actually
think he's evil.
we're going to talk about things that matter. And I'm going to remind people that we do not decide in the beginning of the day how we're doing based on whether or not we
But
got
I
Wordle
would
right.
say that loan officers, there's a higher percentage of loan officers that do games than the rest of the public because loan officers typically like puzzles. That's why they're in this industry.
Our
And
jobs are a puzzle. That's
yes,
it. That's all
exactly.
we
That's
do.
that's my point.
We solve puzzles.
Yeah.
All right. Well, we are gonna. I actually turned off the updates that I used to get on my text messages about what the bond market was doing because we're on the West Coast. The bond market opens. You start getting those notices first thing in the morning, and before you've even taken a shower, you're in a shitty mood because the bonds are off. So anyway, all right, moving right along. So we are going to talk about the fact that this long-awaited summer camp, it starts tomorrow. And if you just had a panic attack because you were thinking it was Thursday, you are not wrong. The regular camp event starts on Thursday, but tomorrow is the NAM credit class where you can get credit. Wait, okay, I'm
Get
like,
credit for taking a credit class.
yeah. Anyway, you be certified. That's the word I was looking for. So if you go to the campsite.org and you put in code CAMPCCS, you get $100 off and you get a camp membership. So
CTS, which
no,
stands
CAMPCCS, like credit class
oh CCS.
Scorpion. Yeah, credit class Scorpion. Anyway, okay. So this is going well. Anyway, so yeah, you can go and do that there. So please sign up. We are looking forward to seeing people in Irvine on Thursday and Friday. And I hope you're planning to attend. They have got blockbuster numbers. Holy crap. So good for them. Yay,
Yeah, I
yay,
believe there's
yay.
over 400 loan officers that signed up.
I don't know. I don't know. It was a
A
big
large
number.
number.
I stopped being updated a couple days ago. So, okay. So Peter would like to say routine is important. At least we aren't starting our day checking the mortgage employdometer to see if we still have employers and resources. And that is, thank you, Peter, very true. And leave it to a loan officer to take us all the way back to 2008, 9, 10, 11, and what our lives look like then. So there we are. Okay, I would just like to have a little PSA for a moment because good morning, Selma. How
Good.
are you? All
How
right,
are
so
you guys?
I'm sure you're really sad that you've missed all of our blah 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 in the beginning. But I was just about to remind people because this was something that was surprising to me on a very very short escrow that I've got going to 14 days, and it started on Sunday. There is a 10-day period when the notice of property being a flood zone is delivered to the borrower and the note date. I
What?
did not remember this at all because I clearly don't do a lot of flood insurance. And the last one I had was a condo from a couple years ago. So, one more time, there is a 10-day waiting period between the notice of the property being in a flood zone being delivered to the borrower and the note date. So,
Oh, dear.
yeah. So just a
And
little.
when what triggers that? Probably the appraisal.
Well, when your disclosures go out, the flood notice should go out, and but they have to anyway. So yeah, so just be aware of that because if you have a short escrow, it is tight as far as getting your loan doc signed on time. Um,
That's why I like doing my loans in San Francisco. There is no flood zones in San Francisco.
you know what? There are flood zones all over the place. So, and you live, I mean, not you live, well, you do too, actually. San Francisco is on the water. I mean, the
I know.
marina was built it was
I'm
built on
not
a
saying it
budge
doesn't
of
flood,
quicksand, for God's sake. So just don't get off your little
but
high
here's
horse.
the
Good
unusual thing
God.
about San Francisco. It does not participate in the flood zones. Yeah,
You can opt out?
apparently the city did way back when, and
Are
so
you
no flood
serious?
zones in San Francisco. It doesn't say it doesn't flood. I'm just saying
Okay.
there are no flood zones.
Excuse me. I need someone to fact check this right now. And my AI boyfriend Claude cut me off this morning, said I'd used him up too much and I had to wait till 1:40 p.m. to ask another question. I literally have a list going of the things I'm going to feed into him at 1:40 p.m. But anyway, oh my God. I really no flood zones in the city. I
That's
did
my
not ever.
understanding. It's always been that way. It's really
Okay.
weird.
We
Now,
need
maybe
some third
something
party
changed that I
confirmation.
don't know about, but that's just
That's crazy, crazy, crazy. Okay, I also just wanted to say that in my life, in the almost, I mean, we are coming up on in the fall, I will have been in the mortgage industry. You ready? 37 years. 37. Good God, I can't even
and you're
freaking believe
only
it.
38. That's pretty impressive.
Well, that's true. Um, okay, that's a lie. Anyway, I okay, so I have had the weirdest conditions come up on Data Verify recently. I mean, and not just on one loan, on a bunch of them. Like somebody's ex-boyfriend that they broke up with like 7 or 8, 9, 10 years ago. We had to write an LOE explaining what that name was that popped up under their name. I'm like, you've got to be kidding me. And random names, random addresses. I had one borrower, 6 separate addresses popped up, and none of them belong to them. They don't even own a house. So anyway, the whole thing is just cray cray. Anyway, so be on the lookout for that, because that's fun to explain to your clients. Here, could you please write in a letter of explanation in your loan file that that's your ex-boyfriend? Anyway, have you had that happen?
No,
No. Okay,
never.
of course. Of course.
By the way, Dirk is apparently proving me wrong.
Okay, Dirk, by the way, is a little behind because he kept telling us to talk about summer camp. Duh, already did it. Duh, duh, duh. Okay, sorry, Dirk. Anyway, here we go. Um, oh, Bill. Oh, listen to okay, this is very funny. Bill says, from my seat, the both of you are very good and experienced originators. Thank you, Bill. He's making a lot of assumptions, but I appreciate it. And he said the type of DNA will outperform 90% of the originators out there, no matter what the rates are. Yes, yes, yes. I agree with that 100%, because as everyone's sitting around having all these stupid conversations about what they wish was happening versus what we are dealing with today in the market, we do just need to focus on what can we do better, which is what we try to do here on Tuesdays at 11 a.m. Pacific. So, all right. So, what if in it quickly? What is the what did Dirk say about the San Francisco flood zones? Is it for
I
real or
could
no?
not do. He just dumped what ChatGPT said. So apparently
Okay.
there are some
Oh,
flood.
it does. Oh, it does say it does participate in FEMA's flood thing, though. So we'll see if yeah. Anyway, that is really funny. Um,
But there's
Selma.
not too many
So
flood zones in San Francisco. There's like a couple.
what?
There's only a couple little areas where it ever floods.
Oh, now you're changing your story. I got it.
I'm just
Okay.
saying there's I've always known it could flood in certain areas, but low lying areas, they tend to
Ah,
attract
all
water
right.
for some reason. I don't know what that is.
Okay, okay. That's enough about that. Good morning, Selma. How are you?
I'm good. How are you guys? You guys are such a
Good.
hoot.
Oh my
Love
God,
listening to you.
Dr. Selma Hepp, SVP, Chief Economist of Cotality. Just want to make sure that we point that out, as I love my smart women very much.
Thank you.
So thank you very much for being here. We know you're busy, and that worked out. I wasn't actually, if somebody else told me, oh yeah, I'll be a couple minutes late, I'd be like, oh God. But I had total confidence in you, so that's good.
So I have something right before this that I can't move, and it's always, it's Tuesdays at 10 my time. I can't move it.
I know, I know. You just tell those people, listen, I got somewhere to be. It's going to be fun. I got to go. So there you go.
It
How's
just say
everything
it's
in
more
your
fun.
world? What, Kevin?
Just say it's more fun than this 10 o'clock meeting.
It's equally fun. It's equally fun.
Oh my goodness. Okay, well, I am looking forward to someday. Maybe there will be a week where we go, you know what? There's just nothing to talk about.
Oh, that would be wonderful.
Yeah, so that's not today or probably next week or anytime soon. So, why don't we just start with what you are seeing out in the marketplace? And I'm going to try and keep my computer from falling over completely.
Sure. So, I don't know where you want me to start. I can talk about home prices. That's generally, what it's a number one topic that people ask me about. And what's interesting is last couple of years in the middle of spring home buying season, we saw mortgage rates surge, right? And it really cooled off, demand and slowed down home price appreciation. And in fact, last year it really cooled home price appreciation at a lot of part of the spring home buying season. Not so much this year. I mean, we did see this inflation issue with conflict in Middle East and sort of that all those type of things tend to shake up consumers, so there's slowdown in sort of consumer sentiment towards, am I going to do a big purchase right now? And mortgage rates, really like shut up again, but we didn't see the same or commensurate slowdown in home price appreciation, which to me was very interesting. So actually, home price, yes, they're slower than they usually are at this time of the year. Not in your guys' area. So you are a whole new beast out there
Yeah, we
with
are.
AI money and IPO monies and all of that that's flooding into that market. But otherwise in the country, it's a steady market, I guess is what I can say. It's not exciting. There's nothing really, there's not hot spots that other than your guys' area that are really worth noting at the moment, which is good and bad. I mean, it's good because we need home prices to sort of level off, to
Yes.
catch up for the affordability to catch up. That's everybody's talking about affordability or lack thereof. So we do need some catching up in terms of affordability, and with rates not helping with that, we'll have to get it from slower home price appreciation and faster wage growth. So that's really what I'm seeing in terms of home prices. It's steady market. Home sales have been okay, relatively same to where they were last year. Again, I think we're looking at very slow and steady return back to where we were pre-pandemic. There's nothing exciting, and probably we shouldn't expect anything too exciting, because that usually means some sort of bubble or some sort of speculation is going on, right? And that's not good at the moment.
Like when
I mean, we'll take slow and steady any day of the week, and we have enough excitement. Geez Louise, we have the bond market. I mean, none of us really need to be doing any sort of gambling, drugs, all we
Yeah.
need to do is go to work and see what is on our plate for the day and what's happening with the bonds and the rates. And oh my God, there's too much. So we'll take slow and steady. We like it. And it is good for all of us, I think. And it was interesting because when I was looking at your Cotality home price index for May, and it was funny because you guys are like a month behind, right? So you're doing, like you're releasing that in July for May. And I remember this thought went through my head and I went, why are they behind? Why can't they? And then I caught myself because for years I've been railing on the fact that I would rather have accurate information and wait for it. And so then I went, oh, I have a whole new appreciation for your 1 month delay. But it was interesting in your May report because we were up 6/10 month over month, 8/10 year over year, but your forecast was 4.8% in the next year, which I wondered if it had something to do with changing the modeling or whatever, which you have not done. So these are forecasts that are very, based on the way you've been doing it. So tell us how you're feeling like in the next year, you're thinking that prices are going to appreciate moderately. We'll take that. And but that's solid growth right there.
Yeah, so a couple things on the forecast. Our initial forecast some months ago was over 5%. You know, as we get more data coming into this year, we see slower home price appreciation. Now, we're still going through a process of revising our forecast model. Actually, we've revised it and it's been rolled out, but we haven't yet incorporated it into our press release. That's coming on August 4th. We're rolling out a new forecast model, which is going to actually show slower than 4% appreciation, 4.7 appreciation, because yes, we are seeing much lower rates of appreciation, and things have changed from the way housing markets worked before, in terms of how mobility impacts home price appreciation, how population growth, job growth, inventories, how all of that impacts home price appreciation. So new assumptions have been built in, particularly around the inventory and new construction. So we are rolling that out in August, and you'll see a lower number than 4.7.
Okay, but like 1% versus 4.7, or
Like
I
two.
mean, do we need to brace ourselves, or are
No,
we
no,
going to
no.
still be okay? All right,
Two,
good.
2.5%, two and a
Okay.
half percent. What's positive, I guess, in a sense, is that when you account for where inflation is right now, and it's again closer to 4 than it is to 2, you are seeing real home prices being negative, which means we're making improvements towards affordability. So
Mhm.
not nominal prices, but real prices are when you take your price on your price tag that you see over time, and then you adjust it for inflation. That's the real price. So that one is negative, not the nominal price. So 2% nominal inflation, but less real inflation. Sorry, nominal home price growth, less real price growth.
Do you get that, everyone? Okay, now repeat it back to me. Okay, just kidding. Yes, thank God we have you, Selma. Okay,
Mhm.
so there was, and I sent this to you, but I sent it to you late because I got it this morning. And Rob Chrisman had sent it to us this morning, and it's generated by Axios Markets, which is, I guess, somehow connected to Morgan Stanley. And the only reason I mentioned that is to the point I made in my email to you, which was, just so you know, I'm not quoting something from that had been posted by some ding dong on X or something.
Mhm.
So apparently there is some new way of measuring homeownership rates in America that the Federal Reserve Bank of Minneapolis has come up with. And so have you seen this at all? Do you know about
Well,
this?
I haven't actually seen it until you sent it to me. But
Yeah, I hadn't heard of this. This says it came out in 2020, or oh no, it was based on some 2024 American Community Survey data. So they were talking about how the Census Bureau has counted the number of adults or people, the homeownership rate in America, which has consistently been somewhere in the 65% to 66% range. But this way, what they're doing is they're counting the actual homeowners that are living in an owner occupied property. And so we have a lot of adult children and other family members living in properties, and they're making sure they're taking those numbers out. So they're saying that um, under the age of 35, only 22% are homeowners, with 37% being what the number was under the previous way of counting, or the Census Bureau's way. And they're saying that 53% of American adults own their own homes, not the commonly cited homeownership rate of 65% by the Census Bureau. So I mean, it makes sense to not count people as homeowners if they're not actually, on title and owning the home. But I just thought
Well,
I find this whole conversation curious, and I would like to at least put a pin in it and come back to it at a later date, because we are also hearing things about how our demographics are changing. We have done there are a lot less immigrants living in the United States. We have had way less babies for many decades. And the projections for where we're going to be in 10 years in terms of population are not increasing exponentially like they have over a very long amount of time. So again, we don't have to like figure that all out today, but I am
Mhm.
curious to see, is this really something to be concerned about? And maybe we don't need to be building as much as we think we need to.
So I don't think that traditional homeownership definition has changed. This is a new, they're introducing a new concept. I don't,
Okay.
and it's separate from, how we historically have defined. We should not redefine home ownership, because the difference is that traditional home ownership rate measured, uh, of all occupied housing unit, what share are owner occupied, and in that measure you are taking a married couple and counting them as owners of this home. In the new measure, you only take one person out of this couple and saying that that person is owner occupier and the other one is not. So it's really, the new
Doesn't
measure is
make
really a
sense.
measure of wealth, how much wealth is owned by people that live in these homes, and this is per capita almost, not by, but we have to remember there's still, a lot, majority of the owner occupied housing is married couples, and there's increasing share that is multi-generational. So if my parents live with me, we're all, by all definition, we're all homeowners. By new definition, only I'm a homeowner. Now if I pass, my parents still get to keep the home. So it's very nuanced, so I would be
Okay.
very careful in how much weight I would give it over the previous definition. I would just say that it's just a different definition. So yeah.
Okay, so just to be clear, so if your parents are living with you, are you all on title and you're all being counted versus one person being counted in this new model? Is that what you're saying? So in your original scenario, your parents and you are all on title. Yes?
Well, we're not on title, but we are considered owner occupiers. Under the new definition, only one person in the household is occupier. Only
I
one,
Yeah,
irrespective of
I
how many.
I understand calling someone an owner occupant if they're on title. I don't understand why you would be an owner occupant if you're like, a mom living there and or a child and you're not on, you know what I mean? So I'd be
Right.
curious to see who are the
I,
people who own the house versus just live there.
But if my parents, for example, contribute to the mortgage payment,
Mm,
even though I'm the only one on the deed,
okay.
there's still, technically, and if like I said, if something happens to me, hopefully there is a trust, or not trust, yeah, trust, or what do you call that thing, like some sort of direction on what happens, and that home
Right.
gets transferred to them. So
Got it.
it's very nuanced. That's my
Okay.
point.
I
Mhm.
yeah,
love this
I've seen
so
this.
much
Mhm.
because this is so typical for everything that we do, which is it's complicated. It's all complicated. So,
Well, part
okay.
of it's also what they're trying to push. So, like, I saw it recently where they were saying that most college students are homeless, and I'm like, "Whoa, how is this? This is terrible, right?" And so they've changed the definition of uh, a college student's home status. If they, so at first it was, homeless was, well, obviously you think someone's homeless, they're living in the street, maybe they're living in their car, okay, expand it. Okay, but then they
Right.
expanded it to, well, okay, if they're living on someone's couch, they're homeless. And then they expanded it to, well, if they live with their parents, they're homeless because they don't own that house. And I'm like, I don't know any student who lives with their parents while going to college considers themselves homeless. That's just so ridiculous. Um,
Right.
yeah, and then same thing on the stats. Like, if husband and wife, own the house together, obviously the wife doesn't consider herself homeless. Or vice versa. The husband wouldn't consider himself homeless, and the wife got it.
Mm.
But I would also extend that who owns the house. It's not just the person on title. It's the person also who, if let's say your parents are living with you and you're by yourself, sole owner, and you were to pass, most likely your parents inherit the house.
Right.
If it's your kids, they inherit the house. So in a way, they're not homeless because they would not be left homeless if you pass. So
Right.
that's my thinking on, it's got to be a
Mhm.
little bit broader than.
Okay, I'm going to push back and just say that if your kids are not homeowners because you own a home. Sorry, but they're not homeless for sure if they're living
Yeah,
with you. So I again semantics too. I mean, and this is also a real cautionary tale and a reminder that we're always telling people don't just read a headline, don't just take a dive into it, right? So I'm
yeah,
so glad we were able to have this conversation with you. So we're not thinking, oh my God, we're at our homeownership rate is tanking and we're all in deep trouble and holy smokes. And I find this whole conversation about affordability and there's a lot of conversations about how younger kids are not able to, or first time home buyers, they're not able to buy houses. And now we're seeing that the Z's were 20% of purchase locks or
Mhm.
in Q2 of 2026. Two-thirds of the market is now millennials and Z's. And first time buyers are still 33% of the market as of June 2026. So in that third kind of number, whether it's 33 or 30 or 31%, that's very consistent, that first time
Mhm.
home buyer number. And whether or
Yeah.
not you think that the first time home buyer is 40 years old, which I think that theory has now been debunked. It was like one survey out of, I don't know, six. Or and yes, it's a little higher than it used to be, but still we have first time home buyers, a big chunk of the market. I I don't know. Talk to us about affordability and how we should be looking at that.
Yeah.
Excuse me. Oh, you didn't hear me? I said
Oh,
talk.
mm.
I said I said
Oh,
talk.
sorry.
Let's talk about affordability because I'm
Mhm.
hearing, okay, there is one very loud person on LinkedIn who has, first he was beating the drum. Oh, we need to have a big, and I mean big. He was talking 20, 25, 30% decrease in values across the board to increase affordability. And I have argued many times that is contagion. It is, you start having prices go down like that, and people who could still pay their mortgage are going to bail out thinking the sky is going to fall just like they did during the meltdown. So I just think it is a horrible idea. And some economists who are friends of yours, as a matter of fact, have agreed with that. But now they're also saying, well, we need a recession. And I'm like, okay, dude, if first of all, hoping that we have misfortune fall on the heads of many so that the mortgage industry can make more money and pump their numbers up. I have such a huge problem with it. That's before we even get to the part where you don't typically have a decrease in home prices during a recession. That is, unless we cause the recession naturally, like we did in '08. And so anyway, so let's just talk through this. And what are your thoughts on all that?
Yeah, I mean, affordability has been frustration for so long that people are now really desperately trying to, grasp at what is that expression?
Straws,
At the
straws.
straws. But calling for prices to plunge it's not a serious housing policy. It's a sort of a blunt, outcome. And the worst thing, it would damage household balance sheets. It would damage consumer confidence, tax base, local tax base, financial stability. I mean, I can just go on and on and on. Think about all the people that are underwater, and then what happens.
Yes.
It's
Yeah.
a vicious cycle. So the irony is that the recession doesn't really make housing more accessible, because think about what happens during the recession. Lenders tighten their credit.
Yeah.
Buyers worry about their job security. There's more job losses. People, and when there is job losses, nobody moves.
Mhm.
It becomes I mean, I can just go on and on. People don't sell, can't save, builders slow construction. Everything slows down. So it's not really a serious solution. That's just my take on it. And I think for majority of economists who are talking about this, they understand the dangers of prices falling just because of a recession. They are saying what the way this hopefully we're going to get to more affordable environment is over time you have slower price growth, you have steady economy, more jobs being created, wage growth that exceeds home price appreciation, and then hopefully some steady decline in mortgage rates. I mean, higher for longer is here due to a number of outside exogenous, what we call outside factors. So we're not going to see mortgage rates at twos, but maybe we can see them in high fives, in some reasonable level. That will help, but it's more about wages and home price relationship over time.
Absolutely. What's
Yep.
interesting is I've had many times when people have said to me, well, I'm waiting for the next recession to buy my house because then houses will take a dip and I can afford it, blah, blah, blah. And it's so funny is that when I run into them, so did you buy that house during that last? No. Yeah, you know why? Because the recession is not the best time to buy a house, because the reason there's a recession is because people can't afford to buy the houses. And it's just so funny how people think, oh, well, I'll just wait till the houses dip and then I'll buy. No, the best
But
time to buy a house is when you can afford it.
Yes.
typically, though, the housing market does well during recessions, typically, and especially if rates actually do go down. Fannie Mae has revised their forecast for rates. They're expecting 6.4% through 2026, and possibly will tick down to, get ready for it, kids, 6.3% in 2027. And so we're not talking about major swings here. And we have an entire mortgage industry that has based its whole existence on the next refi boom. Instead of, we provide housing, we provide solutions for borrowers who want to use the equity in their homes. We provide opportunities for investors to buy rental properties. It is literally, we have lost sight as an industry on what really matters. And when if we and so when I hear people saying, "Oh my God, we just need this," or we need a recession, we need to have prices play. No, you need for your growth to show quarterly increases, and you need to backstop what you spent that you shouldn't have in the last 4 years. And that's what you need. But what the industry needs is a refocus on the borrower, in my opinion, and what we can do to help homeownership. So there you go. That's my opinion, though.
And you're sticking to it.
What?
And you're sticking to it.
Exactly.
I got to say that my portfolio right now is pretty a good mix of purchases and cash out refinances. Um, it's it's like right where you want it to be.
It's interesting you say that, Kevin, because it is, I mean, mine is probably mostly purchases right now, but MBA mortgage applications, which I always find very interesting, purchases are down 7% week over week. Okay. And again, I the week over week thing, I'm like, I really prefer a wider look at what's going on. They're down 2% year over year, but refinances are up 4% week over week and up 7% year over year. And as of last Wednesday, we were still 17 basis points lower in rate than we were a year ago. And, yes, we
I would
have
say
these,
there's a blip on the previous week because the 4th of July numbers got pushed into the next week. So I would say that that's just a 4th of July blip.
Okay, and I would say that's Kevin just pulling that idea right out of his ear, and maybe he's right, and maybe it's just the way it
Sometimes I
is. Who
am.
knows?
I got a 50-50 shot. So
A clock is always right twice a day.
yeah.
But it has been interesting with the ongoing disaster. Well, okay, maybe that's hyperbole, but things are not great globally. And so we do have the oil prices, oil's up, oil's down, but it has come way off its highs. And that price is not really reflecting itself at the gas pump yet, because as we know, you got to work through all those inventory levels and you never know what the hell is coming next. So it, again, if we can just stay focused on what's in front of us, which is I've got loans to close. Kevin has loans to close. We all have people to help. But knowing this kind of thing helps us help them, because it's so easy to go, following some person on TikTok or get caught up in the sky is falling narrative. And then you are paralyzed, to Kevin's point, and you never buy a house. So, yeah, I don't know. That's my thought anyway.
Can I ask you guys a question as a consumer? So I got an offer in the mail for an arm, for refi for an arm at 5%. Is that reasonable?
No, it's
No,
not. Did you call them?
no. I feel
Yeah,
like it's some I feel like there's something wrong about it, but I thought, well, maybe I don't know something. So I wanted
Yeah.
to ask you guys.
I've seen those too, and I'm like, and I've also seen the ones that like 30 are fixed at 5.75, and the only way they could possibly do that is they're not paying their people any money.
well, no, the only way they're possibly doing that
Oh,
is
they
look
make
at
it
how much
government.
it's going to cost you. So literally, I've seen quotes where somebody's being quoted some ridiculous rate, but it's going to cost them $45,000 in points. I'm not joking. So
Yeah.
it is, sometimes they do that and they count on someone not reading the fine print. The other thing too is, as much as there are clients who will kind of grind you over, okay, what is all this, what are all these costs, there are also the people who just don't see past the note rate, and so they don't look at the APR, they don't look at anything. And so it's really important, and we talk about this fairly consistently, that when somebody is saying, hey, another lender down the street just quoted me this, get the LE. And the first thing you look at is it locked? I mean, is that a real rate? Did you really lock it? And then break down what the costs are. And then we've also seen on the closing statements for like the iBuyers, if you're trying to sell your house, they're like, oh, we're not charging a commission. We're not. Well, when you look at those closing statements, it's uh, okay. I have no words. Like, it's crazy how expensive they are. And so, but people don't think, they're like, oh, I can just sell my house on my phone.
Yeah, but there's no
I
real
don't
estate
have to move.
commission,
I don't have to leave my couch. What, Kevin?
Mhm.
and there's no real estate commission. Oh, but there's all these other fees. Yeah. Although
Well,
I think
right. So
I
there's no
mentioned it.
commission per se, but there are fees that
Yeah.
make a commission look like a good deal.
Yeah. I have actually had two deals this year from the local guy that buys houses in the area. Cash on sight unseen, no loans necessary. Just here, I'll buy your house. They're advertised on the radio all the time. And for whatever reason, for two of my clients, they bailed at the last second. And so I was able to step in and save the deal and get them the money they needed to move on and then sell the house for real prices. So it worked out well for them.
Okay, so you say for some reason. Did you ask what the reason was?
Why they didn't do it? No, they decided that they didn't want the property at the last second, both times.
Okay. All right. All right. Yeah. I mean, it is when there are so many, we all get those kind of offers in the mail. I mean, yeah,
They're
we
on
all
the
get all
radio all
sorts
the
of
time.
crap in the mail. I tell my clients, I'm like, you know what? If you get something in the mail, send me a picture of it. Let me see. And it starts when they buy their house, because you know how once somebody goes on record and those little vultures are
Mhm.
culling public records to see what kind of
Yeah.
money they can siphon off of someone. So, for the rock bottom price of 99.99, they will send you a copy of your deed of trust, which you could pull offline eventually. Anyway,
Mhm.
um, so I start with, if you get something in the mail, send it to, and you're not sure if it's real or not, send it to me. And you should see the crap they're getting. Holy schmoly. It's terrible, honestly. Terrible.
Mhm.
All right. So I know that Cotality has also been focused on delinquencies and foreclosures. So tell us where we are in the scheme of things with that, pretty please.
Yeah, so we have our loan performance report that we've been putting out for a number of years, and on the average national rate is still really really low. It's maybe gone up a little bit, but it's really really low. Really, the reason why I'm looking down my desk here is my dog is right between my legs, and he
Oh,
finds it's the best place that he wants to play with his toy right now.
oh, we want to
Um,
see your dog.
oh, he's the cutest thing that ever existed.
Well, you'll have to show him to us at some point.
I will, I will. But the real problem is really in the FHA space, right? In the
Right.
conventional space, we don't really see a lot of going on, but it's really in the FHA space. And delinquency rate is up, but then really when you compare it to pre-pandemic levels, you're like, well, it's a little bit higher, but it's not significantly higher. We've had certainly times in our mortgage history where it's been higher, right? So you sort of like, and it's leveling off, and then you think about how many originations we've had in recent times in FHA space, so it's potentially we've sort of expanded that circle, what do you call it, where you can lending space, so you're potentially including some folks that are of higher risk, but so trying to, as we're talking, I'm trying to actually find a map here that we actually mapped serious delinquencies by metros, and what's interesting is that um, in our latest data, almost 80% of metros did see increases in serious delinquencies. So that's almost 80%. It was about 50% in at the end of 2025, so in December 2025. So we are seeing higher share of delinquencies, and again, a lot of that is from FHA, which has gone up to I don't even know where it is at the moment. It's at 6-7% or even
I
more.
saw 5.4 this morning, but I can't remember where. But yeah,
Maybe
it's much
MBA.
higher than everything else for sure.
Right, right. Um, so I think this is one of those spaces in consumer credit that is it's, I don't want to say it's breaking, but there's significant stress. Now, where do we go from there? I think it will depend on what happens with the economy. If the people can keep their jobs, it depends on how much equity they have in their home, like how long they've been in the home. One of the highest increases, one of the highest one okay, so 2023, 2024 were years where we saw highest share of early delinquencies because people bought at top, and for many of them home prices may have reset, some even more, so they don't have a lot of equity. Jobs may have been hard to get, and things like that. So there is definitely pockets, but I don't think we have a bigger picture is still relatively healthy.
I wonder how many of those people bought into the idea that, oh, just buy now and you'll be able to, they were promised they could refinance within a year. I mean, I heard of a lot of that. And I think that was a humongous issue because I never promise my clients they can refinance. I tell them, we'll watch. If we can, great. It really needs to be worth it. You don't want to do it every time you go down a quarter. And I'm really cautious with that, but I don't think that as an industry, we are cautious with that. I think there are a lot of promises made, and especially, again, back to we have an industry that is now, decided that the only way out of any issue is to a refinance boom. And to everyone's point, that's not happening anytime soon from what
There's
we're
something
seeing.
about
Yeah, but it's not just even the only the industry. I think the narrative back a few years ago, across the board, economists, everybody was expecting rates to be lower by this point, like
Yep.
everybody. So it was just that the economy really played out in a much different scenario than a lot of people expected. And and the interesting thing too is how much actually consumers remained resilient in all of this. And that's, I think, been a surprise to all of us, is just the resiliency, consumer resiliency. And a lot of that, I think, is being fueled by, we talked about AI and San Francisco area, but equity markets being as strong and accelerating over the last few years, just how much wealth has been accumulated. It's incredible. It is really incredible. I mean, it's concentrated, but it's incredible.
I yeah, it's always interesting to see how it plays out. I just feel like I've gone through so many cycles and decades upon decades. And okay, I know I now sound like an old crone and I'm like Rumpelstiltskin. um, but again, 37 years in this industry is not nothing. And I've watched this over and over again. And I just don't believe in banking on the next refinance opportunity. I don't. I think we focus on purchases. That's what we did when I got into the industry. Is it was really, we just did purchases, and rates were really high, double digits, for a while, and it was a completely different world. And yet we were still able to get people into places. And it's not like they were buying $20,000 places at 12%. They were buying two, 300, $400,000 places at that interest rate. So it's not like it was so cheap then and it was no problem. I mean, we had the same issues then that we do now, except, people didn't have car payments that were $1,200 a month, and they weren't eating out 7 days a week. And you know what I mean? And so there's a lot that factors into this affordability thing. And so we have a lot of affordability to solve that isn't just related to housing. So when the Fed is talking about hiking rates, well, that's going to have an impact on everybody's economic situation. And so yeah, it's just complicated. It's just so complicated.
Hey, if I
So
got a second here, can we roll back to the foreclosure numbers? And we all know that during COVID, they basically stopped all foreclosures. But the reality is, one of the major consistent causes of foreclosures is the death of the borrower. If the borrower passes away, they obviously stop making their payments. And there was an article in the Wall Street Journal this week about a family that passed away, and then the bank
the
for
whole family?
the whole family, yeah. And
Ugh.
um, now, whether they were murdered, whatever it was, they never went into, they didn't know. But apparently, some guy bought a foreclosed property, and then when he entered, there was 3 dead people in the house. That was the article in the Wall Street Journal. But it was like, but at the same time, I mean, I had a recent purchase of a foreclosed property, and when I investigate, oh yeah, the woman who owned the property had passed away in the property, and the family didn't live in the area, and they decided just to let it go. It didn't make sense for them to try to rescue it. It was a reverse mortgage. And my thinking is, I would bet that is a lot of FHA's foreclosures, because FHA does reverse mortgages to a large extent. And, when the person dies, if they don't have heirs, then it's just a foreclosure. Am I wrong on that, Selma?
Yeah, I don't think you're wrong. I don't have any stats on that on hand, so but I don't think you're wrong. And yeah, yeah.
Put that on your list of things to do, Selma. Find how many dead people are responsible for foreclosures versus just stopping making your payments for a regular reason, like you lost your job or you just, don't feel like it. Holy smokes, Kevin, that is dark.
I just don't know how you would identify that in the data, because when we look at our loan performance data, I don't think that anywhere in there is
You
like
can't
a
tie death
reason.
certificates with date of
Okay,
death.
listen, I bet we can put Palantir on this, because there's got to be some way to have AI go in and pull all the death certificates for the surrounding area, tie it to a property address. Come on, Selma, you can make this happen. I know you can. Good grief. Oh my goodness, Kevin, that is dark. I don't even know what to do from there. Okay, so housing starts and permits, they were up. Starts were up 20% month over month, but it was almost all multifamily. Um, May starts were the lowest in years, in 6 years actually,
Wow.
and so that could have something to do with that 20% number. But the single family starts are down lowest in a year. Um, God, I just have dead people in my head now. Thanks, Kev. Okay, retail sales for June were up 0.2% month over month. And again, these numbers are a little funky just because whether you're looking at the headline number or the control group, like gas is included or not included. So, anyway, what are your thoughts on retail sales? I mean, people are still spending money, right, Selma?
Well, yeah, that's my point. People are definitely spending money, and retail. The other, but there's an interesting caveat here. It's when you adjust for income and you adjust for inflation. Um, People are spending less than they were. They maybe are
Oh,
spending dollar-wise more, lower income households, but it's because everything is costing more, right? But when you do a real adjustment, people in lower income groups are technically spending less, quantity wise. But when you look at the CPI and just how much the essentials have gone up, that's the part that always it just always concerns me, in terms of you're talking about the cost of cars, but also, vehicle maintenance and repair, how much it's, the top items are some of the most essential items like electricity, vehicle maintenance and repair, insurance, medical care, trying to think what other things, well, apparel, but, I guess,
Grocery,
you know, say it again, please.
eggs, bread, milk.
Yes, food. Yeah, as well. Yeah.
it's not just Birkin bags.
You
Oh
know,
my.
what's interesting though, I was thinking about this because, before the pandemic, I would indulge myself for my birthday, for something nice. I would buy myself something nice. But the prices of luxury items have gone up so much
Yeah.
faster than overall inflation that I no longer think about buying myself a luxury item because I think I feel silly spending, say, I'm just a stupid example, but maybe a bag was $1,500 that I would give myself. And now that same bag is $5,000 and I'm not going to buy it anymore, because, but, the reason why they can put prices at those levels is because there's enough people,
So someone's buying them. Someone found out
someone
you
is buying.
someone
Exactly.
found out you like those particular bags, and they're trying to get back at you, and they're buying them all from you.
I bet if they shut down Instagram and TikTok that those sales would plunge because everyone's seen all that and they're like, "Oh, well, I have to have that too." I mean, I've just gotten to the point where I'm like, I would just rather have an experience with my family, my kids. I don't, like I want nice things, but I don't want ridiculous, outrageous things. So I watch all this madness and I think, are you out of your freaking minds?
Mhm.
It
Mhm.
is so nuts. Nuts, nuts, nuts. Okay, just a reminder to people that the new condo rules, unless there is some, Hail Mary that happens at the last second, those are going into effect the beginning of August. I think it's August 3rd or something like that, August 3rd, 4th, 5th. And every single condo is going to require a full review. And there are resources for your people who already own condos. Just I keep reminding you of this, and I know I sound like a broken record, but I don't care because it is so important. Those people are really in, some of them are not in good situations because they're stuck in a homeowners association that has kicked the can down the road for way too long. Now they're having to deal with the new legislation, the new guidelines, and they can't sell, they can't refinance, and they need help. So, with all that, make sure you're aware that as of the beginning of August, full condo review. And then again in January, we're going to have the reserve requirements go from 10 to 15% for the HOA. So, this is going to be something to watch and make sure you're really helping your condo owners and making sure you're helping the buyers understand up front the vetting process that we do on the HOA and how important that is, And I also thought it was really interesting because there have been a few trade groups in the industry that have called for FHFA to wait, do a pause on putting those guidelines into effect. But I thought it was something I didn't see MBA on the list of the trade groups that have asked for that. So I wonder why. Like, why would MBA not ask for it unless they did and I just missed it, which is entirely possible. But anyway, so just
Saturday, NMLS is going to remind all of us that we have to renew our license or registrations, take our classes for 8 hours or however many hours you need to take.
God, we have to do that again this year?
I know. We can't even say it for some reason. I think how many times we've
That's
done
a joke, Selma. We teach it. We teach continuing ed. So, but again, on that note, I think it's August is the deadline where you have to go in and do click, click, click. You're supposed to answer those questions again. We would just like to encourage you to call NMLS and have them on the phone while you're doing this, so you don't end up paying for, a credit report or background check that you don't
wait till the
need.
last day to do it. It doesn't cost you anything to do it and get it done today.
Yeah, it's actually very quick. They're super helpful on the phone, and you don't want to wait till the last minute because they have to then go and check you out and verify all your information. If you don't give them enough time to do that, then you are going to be without a license potentially. So you don't want that.
And then you'll have a lapse on your license record, and that doesn't look good.
Right. I mean, Kevin would know.
Yeah.
Oh, wait, just kidding. Okay, so someone is saying looking for a date. Oh, yeah. So we are working on putting together a list of classes in person.
Definitely going to Glendora. We just haven't got the date. And why we don't have a date is, the facilities are not available every single day. So we have to figure out, okay, which date are they available? Which date can we get people to it? So it's not that simple to get the date.
And they're not cheap. So it's, yeah, I saw an online webinar that was $140. And I'm like, wow, they're not even paying for lunch or a facility and they're charging that much. So that was interesting. Selma, is there anything else that we should have covered that we have missed somehow?
Well, you guys never miss anything.
Please. Yeah.
Yeah.
I'm sure there are people who are rolling their eyes right now going, that's not true. Or
well, half of the time when I come on the show, I'm hearing from you for the first time on things. So, you're really on top of it. Trust me.
Okay. Well, maybe we could get a little consulting job with Cotality and we could help, with some of this stuff. That'd be great.
About the new appraisal rules that are coming out too.
Well, it's not just oh my God, don't even get me started. Actually, I booked.
Don't get me started.
I booked someone. We are going to do another dive. We did a dive a few months ago into what is coming. I mean, like we are really early. I think when I looked, it was like, I don't know, January, February. You can find it on our YouTube channel, Mortgage Pros 411. Anyway, we did a very thorough, discussion about this and what to expect. So now it's around the corner. So November 2nd, 3rd, right at the beginning of November, those changes are happening. And now we're getting a slightly different version of what it will look like. So that will be interesting. So that is coming up in the next month or so, that show. So anyway, you have that to look forward to. Anyway, Selma, we love you. And thank you for always being here. And even though you have a meeting right before, we love you. And to everybody, it is always an opportunity for us to go help someone. And that is what we need to focus on every single day, despite all this crazy crap that's always happening in the industry. So have a wonderful, wonderful week. We will see you in Irvine. And
if you're there, come on, say hi.
Yes, for God's sake, please come say hi. That would make us really happy. All right. Mwah, kisses. Bye.